All right, so for those tuning into the stream, today is day 10. Today's class is going to be all on TradingView. We will not be we won't have a presentation. Instead, I wanted to break down the charts live with you guys and walk you through some interactive analysis and breakdowns of the chart. So we're going to be talking about daily structure and volume. To start off, let's begin by talking about volume at the highs versus volume at the lows, as kind of a continuation to the VPA Foundations class as well as yesterday's class. So first things first, right? Let's talk about volume at the highs. Now notice this is a separate watch list that I have for myself, which is called a recap. I like to do this. Oh, sorry, I'm not sharing my screen. I just realized. All right, should be good to go. Okay, so on the right hand side here, you guys see a recap watch list that I have currently. I suggest that you guys create some sort of recap watch list and shuffle around different names every now and then, depending on what type of topic you want to go over, right? And what charts you want to review. Set them aside, and then when it's time to actually come and review them, clear your drawings on them and start from zero, and then dive deep into the charts and break them down. It's really gonna help you kind of. I don't like the term backtesting. I feel like backtesting is more so for like scalpers and day traders, but it helps you study the charts in the past and how different names worked and what they looked like before they worked. So what's the difference between volume at the highs versus volume at the lows? Very simply, right? We know that institutions and big money are smart, right? They want to buy into their stocks at the cheapest levels possible, and they want to sell at the most expensive levels, right? To turn a profit. One thing that we also know is that institutions are not small fish like us, right? They're not retail, they're not trading in a select amount of shares that they can just buy in and out. No. They trade with a ton of liquidity, right? They're buying in the millions and the hundreds of millions, right? So for them to actually get filled on their positions, they need certain tools that they can use in order to actually get filled, right? They can't just buy in as they please at whatever price. No, they need to make sure that there is liquidity on the other side that will either buy their position if they're selling or sell their position if they're buying, right? So they need to make sure that there is counterparty liquidity that will match whatever amount of shares that they're looking to trade. And for them to do that, they need certain tools, right? Those tools are what I like to call liquidity grabbing events. I'm sure you guys have heard of a liquidity sweep before, which is something that looks like this. You have a certain level, right? Let's just say the 180 level. Price is moving up into it, and then you get a big wick and a big failure. We call this a liquidity sweep, right? Because that liquidity up here got swept, and the buyers that went long up here are trapped and are underwater. And same thing vice versa to the lows. All right, price is consolidating, has an initial breakdown and then reverses. The sellers down here, the short sellers down here are trapped, right? Everyone that went short here got squeezed out, right? Those events happen quite often, right? Now it depends on the size of the event that we're talking about. Are we talking about really huge volume on the daily time frame? Are we talking about something more intraday session, right, with a small sweep / small wick? Or is this a bigger kind of move that institutions are looking to execute on, right? So there are quite a few things that they could do. The first one that I want to talk about is all-time highs, right? Now we're talking about when they're looking to exit out of their positions. So the reason why all-time highs can be very tricky is because a lot of times you'll see that all-time highs get swept, right? And the reason for that is because what happens at all-time highs? At all-time highs, a stock is being watched by a lot of eyes, right? And as I mentioned, institutions need a lot of eyes that are watching a stock so that they could execute their positions. A great spot for that is at new all-time highs, because at new all-time highs, everyone's getting that notification. Nvidia has set a new all-time high. There are headlines out there about Nvidia growing, Nvidia being at the highest market cap that it's had, so on and so forth, right? So whenever you see a lot of these headlines come in that might not really mean much from a fundamental perspective, but from a liquidity standpoint, no, it does mean something because it attracts a lot of eyes and it attracts a lot of traders. And that's exactly what institutions look for, right? So all-time highs is a very, very good spot to think about that. Now, by all means, that doesn't mean every all-time high is going to get swept. Of course not. In fact, some of the best breakout buys are going to be all-time high breakouts, right? But this is when context comes in and you understand what chart has room to move up higher versus which one doesn't, right? So, okay, I don't want to go off on a tangent here. So, some of the common outcomes, right, of what happens when volume pours down at the highs, right? When we're talking about liquidity, liquidity also kind of means volume, right? High liquidity means high volume. So what happens when there's a lot of volume off the highs? There are four kind of different outcomes that can happen, right? Or five actually. The first one is follow through, right? We know that on certain names, when they're breaking out of a base, right? One of the best names to actually study is NVIDIA back in 2023. This had a massive all-time high breakout right up here with a lot of volume, and that had a ton of follow through, as you can see, and went on a multi-week run and almost doubled, right? It was just a straight shot up. That's the first outcome. The other outcomes are on the flip side. They're bull traps, they're failed breakouts, right? They're rejections, and they usually can mark either the start of a distribution or kind of a more finalized version of distribution where things actually start to potentially break down, right? We don't know when price actually breaks above all-time highs what it's going to do, right? We don't know if buyers are going to be stepping in. We don't know if sellers are going to be distributing, right? We don't know if institutions are exiting their positions. The only thing we can do is simply watch for the reaction, right? And as price reacts, we execute, right? So a clean example of this is, look at this breakout here on the video, right? The daily base from back here did kind of look distributive. I won't say it didn't, right? Especially starting off with this massive failure on earnings. I would have thought that, okay, maybe this is starting some sort of distribution, right? But when you think about it, right, this had just come off of a big bear market where it sold off quite a ton off the high, right? So you got to understand what was price doing prior to this base. So we had that correction and then we pushed out higher, consolidated at the highs, and then broke out, right? So does this look like a stage 3? We potentially, right? But we don't know. And that's why I was also mentioning yesterday not to be that guy that's trying to identify exactly when a name is going to enter a stage 4. Instead, just try to recognize what type of pattern we are in. So in this case, it might have looked similar to a stage 3, but it resolved higher. That's going to happen, right? Stocks will not always move in the perfect market cycle that we know of, right? Where it's stage 1, stage 2, stage 3, and then stage 4, right? It's just simply not. This is not how stocks move all the time. This is the general framework that we look at when we come to trade stocks and the different type of market cycles that the markets do enter. However, there are certain times where names could be consolidating at the highs and then break out even higher, right? And set up what is called a reaccumulation at the highs, which we will be discussing next week when we dive deeper into distributions and accumulations and how to identify whether a name is potentially setting up an actual distribution or is it actually going to go for a breakout instead. The easiest way to just do that is to just simply look for the reaction, right? So on this day here, this was not a day that I would be willing to go short, right? You do not want to short a very strong day like this. No lower wick, just a grind all the way up, close out high of day, right? Increase in volume, clear sign from buyers, no sign of sellers whatsoever. Now compare this bar to one that looks like this, right? Easy night and day difference, right? Clear, very clear. So you always want to watch out for the reaction and see when volume is actually pouring in, what is price doing, right? Now, as we mentioned, your trading analysis must stem mainly from price action and volume, right? And you always want to pair the both. You never want to just look at price action. You never just want to look at volume. No, you want to look at price action, how high the volume is or how low it was, right? And when there is volume, what did it do to price if it did do anything, right? So in a case like Nvidia up here, when you see sellers, when you see that very high volume, right, and you see that massive liquidation bar and a massive bearish engulfing, then you know, okay, this is most likely distributing, right? In fact, without a doubt, this was distribution. It was very clear to tell. Although the base was not set up, this upper base here was not that, it didn't take that long to form, but it was still distribution nonetheless. So when volume comes in at the highs, right, you always want to be cautious of it. From what I've seen, a lot of times it can resolve lower, right? But this goes back to understanding market cycles and what type of stage we are more likely than not in, right? We all know that trading is a game that has a lot of uncertainty and anything can happen, right? We can get any outcome, no matter how good a setup looks, no matter how good a trade looks, we can still get any outcome. The only thing we can do is just put probability on our side, right? And think in terms of probability. Because as long as you have probability on your side, right, and you're managing your risk, right, and you're going for those big ones when they do come, then you will be profitable at the end of the day. So back to this, right? You always want to watch out for what the reaction of price is off of a level at the highs, right? Another example of this is PLTR. Hold on, let me just clear the chart. So PLTR actually had, I don't think a lot of people noticed, but if you go to extended hours, it had a massive failed breakout on earnings with certainly an increase in volume, right? When you see a bar that looks like that, you know that buyers are in trouble and this is definitely setting up to be the top for some time, right? At least an interim top. So you watch for the volume to come in and then you pair it with the reaction of price. One of my favorite distributions that I've recently called is actually Bitcoin. Now, I'm not a massive fan of reading volume on Bitcoin because it's kind of messy, as you guys can see. I think IBIT is a better one to look at. But even then, right, the volume is not the best to read. But so when price is at the highs, right, and you notice volume coming up the highs, I want you guys to ask yourself two questions. Question one is, what did price do prior to that high? This is a very, very important question. And the reason for that is because we know that stocks don't just move up in a straight line, right? So when a stock moves up in a straight line into a new all-time high, then you get hit with volume, right? And then price sweeps. You know that this is more likely going to be the top. And that's exactly how I was able to call top on Bitcoin, right? The question that I asked myself was, Bitcoin is ripping into new all-time highs, right? We already have this base. We've already had a big run off the lows. And now Bitcoin is setting up in a 10-day run to new all-time highs. What are the odds that Bitcoin continues on a run above that after already ripping 10 days in a row? Not high, right? That is important. This chart is very, very different to a chart that looks like this. this breakout here. Why? Because this actually had its consolidation. It had time to fuel up, and it pulled back right under that all-time high resistance, so that when it broke out, it actually had that fuel from back here to actually push out and break out. Right? Do you guys notice the difference between this chart here and this chart up here? That's question one, right? What did price, where did my question go? Was it on a different chart? What about just rewrite it? And then question two is going to be, what did price, actually, how did price react to the test of the highs? Right? And the reason for that is because that's going to paint you the picture of what's actually happening, right? If you see that price enters the new high, and then you start getting bearish engulfings at the highs, you start getting a lot of bull traps, failed breakouts, right? Large upper wicks, then you know that sellers are stepping in and institutions are using that high as liquidation, right? And someone is getting out, right? They're not buying this all-time high breakout. If you can answer these two questions to whenever you see that high volume coming at the high, then you could more likely than not answer what's coming next, right? I'm giving you guys two very, very good examples. Compare this all-time high breakout to the one that I showed you prior, and I'm sure you guys can tell a extremely night and day difference. Is that making sense? All right, so some of the other examples that I have in the video, although this chart is getting kind of messy. But let's take it back here. And let me actually, guys, by the way, I think I might set a 2-hour class in the last week just covering this chart. I mean, I'm just in love with it. Like, I just want to tattoo it on myself. I don't think you guys understand how many times I've looked at this distribution. Although I kind of got a bit frustrated today because I was short and my win went back to break even, but still this chart is just too good and every part of it just makes so much sense. But yeah, we'll talk about that later. So a good example is back here, right? What did NVIDIA do prior to this new base at the highs? We just came off of a massive rip from the low to the high of 111%. And this isn't a small company, right? This is the leader of the US stock market. So we started to top out from here and volume started to come in. And then after that, right, what did price do? Multiple all-time high sweeps, right? No follow through whatsoever. Price is already extended. So you ask yourself these two questions. What was price doing prior to this all-time high test? Price was very extended to the upside, right? It looked very climactic up here. And then when volume started to pour in, although it wasn't that high here, but it started to pick up here on earnings, price did not like that earnings test, right? And what happened? Price ended up fading from all-time highs of about 9.3% in 3 trading days, right? Which is pretty big. And then it continued to even sold lower the next after a couple of days. But yeah, so whenever you ask yourself these two questions, you are more likely to answer what that volume is doing, right? However, I will say, notice how I said most likely, because there are certain times, right, where we will be wrong. And a case of that is on the same NVIDIA chart from back here. NVIDIA did rip, right, up into here, up into this all-time highs test without any true consolidation, right? This was just kind of a straight lineup, right? But notice how volume was not that high, right? So when volume is not really increasing, right, although it was above average, you don't want to have your eyes lasered on this, right? You always want to have your eyes lasered on the names that actually have volume, because that means something is happening, right? A reversal could potentially come out of this, or a breakout, right? Depending on what you're looking at. So don't just think that if you can answer these two questions, then you can automatically know what's going to come next. You can't. You never can. Right? But this also goes back to, I hope you guys know, now I'm starting to really tie everything in together. Right? After building up that mental framework and then starting to talk about volume price analysis foundations and then talk about market cycles. What is one of the things that I was talking about yesterday? If someone can remember, what did I say about when price is entering stage 3? Who do you not want to be? First, exactly. So on this NVIDIA chart, right, we don't know up here whether this is going to enter into a stage 3. Yes, it is extended. Yes, we are seeing some volume at the highs, which is the answer to the two questions, to one of the questions. The second question is, was there a reaction? No, there wasn't. Right? In this case, you do not want to be first. Let the first shorts attempt it. If they win, they win. If they lose, they lose. Right? Most likely they will lose. And then from there, price continued to get really extended before eventually topping out near the highs. Right? So whenever I'm talking about any topic, right, I want you guys to try to kind of tie it in with some of the other topics in the past that I've talked about, right? Because the way that my system works is all the different pillars that build my system complement each other, right? So when, for example, when understanding the market cycles, it doesn't just come to me blindly choosing, okay, what market cycle I win. No, it's that paired with stuff like what I'm talking about today, right? When analyzing volume, right, and understanding what does it mean when volume comes in at the highs and what should I look out for in correlation with what market cycle stage we are in, right? So everything kind of complements all the pillars, right? The different kind of areas of my trading, they complement each other and they make the system full, right? And when they make the system full, it also makes it adaptable because I'm able to adapt to whatever market conditions / environment we are in. But yeah, so another clean example of NVIDIA, right? So that is what to look out for when volume comes in at the highs. Right? When volume is low at the highs, right, I would just kind of be a bit cautious of shorting and or longing. Right? As I mentioned, stocks don't always have to be doing something. Right? A lot of you guys are always thinking, what is this stock doing? This stock has to be going somewhere next. It's either up or down. I need to know. And truthfully, sometimes stocks don't go anywhere. Some stocks are going to consolidate for months. Right? One second, guys. So some stocks aren't gonna go anywhere, right? They're just gonna continue to consolidate. Yeah, Johnson Johnson is a good one. It stayed in that base at the highs for years. Zom is another one actually, until it eventually broke out. By the way, is anyone still in this? Please, someone say yes. Please, please, please. Nice, brother. Nice. I still got my April contracts. Did take a trim on them today, but I'm still holding, and this has definitely been one of my best career trades. But yeah, so this name consolidated for years, right? It's been at this base since 2022, which is insane, right? In 4 years, right, or 3 years, price has gone nowhere until it finally broke out. So always remember that price doesn't always have to be doing something. And a very good kind of way to avoid not to avoid trading stocks that are going nowhere is by reading volume, right? If volume has been low, whether at the highs or at the lows, and you're not really seeing a volume pop or an ignition in volume, then avoid it because chances are this is not going to go anywhere, right? Stocks will begin to move when things start to be looked at by a lot of people and volume begins to pour in, right? When volume begins to pour in, then a name could potentially enter an uptrend or a downtrend, begin to break out or break down out of a base, right? But if the volume remains low without any prior ignition of volume in the recent days, then it's more likely that this is going to continue to chop around until some sort of catalyst comes or until that theme gets ignited again, or until the market just gets some volatility, right? So always keep that in mind. You always want to look for it doesn't have to be anything major, right? I'm not saying you need to see insanely high volume, but just see some volume, right? And then you could potentially look to trade, whether it is longs or shorts. So when volume is low at the highs, right, that is usually good for longs, right? There's a misconception in trading about markets moving up on low volume is bad, especially on the indices. And I used to be one of them, especially in my early stages of my career. I used to think when QQQ is moving up on low volume, this is bad. But the truth is, when you actually go ahead and backtest, all of the moves up on QQQ or on any index have come on low volume. There was an ignition that initially started this leg up, but then from there, it's just a slow grind up. Right, so always keep that in mind. And if a stock pops into the highs, begins to consolidate under that high and low volume, then that is good. Right? Generally speaking, that is what you want to see when we talk about continuation to the upside. But if you want to trade the reversal and look for this name to top, then you want to see volume pop in at the highs and price reflect that. Right? But then how do we say there is strength? There is a strength in rallies if rallies are on low volume. Well, that's the thing. You want to see volume as the rally begins. Right? You don't have to see increasingly high volume as the rally continues up. You can. That can also happen. And the key is to identify what price is actually doing. But for example, if you go back to Nvidia, the breakup from back here was on high volume, right? The initial days. But after that, volume was not that high. Right? It stayed right around average. And price continued to drift higher. And then volume popped in. Right? You don't need to see high volume every single day. In fact, if you were seeing high volume every single day, I would actually be kind of sussed out about that. Right, so you just want to see some sort of initial ignition, and then the market can't continue to glide higher on lower volume. Now let's talk about vice versa. Right, high volume at the lows. High volume at the lows is the kind of number one most important thing that you want to look out for when it comes to identifying names in a stage one and names in accumulation and names that are bottoming out. Perfect example of this is the same BABA chart that we covered yesterday. This is extremely important. In all of these names that I have, we saw high volume at the lows. Right. This is one of the most important aspects to actually finding out a name that is bottoming. Another one is Baidu, which made new highs today actually. Usually what beginners think whenever they see volume coming at the lows is that everyone's selling, it's over. Institutions are dumping out of this name at the lows. This is everyone's pouring in short. This is going to continue to crash, right? But instead, what it often actually means is capitulation, right? This is when the final leg of selling comes, right? And when kind of the name actually begins to bottom. And what's actually happening is the weak hands that don't trust in this name are dumping out, and the strong hands are the ones that are buying in, right? And think of this kind of in a logical perspective. For every buyer, there's a seller, and for every seller, there's a buyer, right? Someone has to buy every sell, and someone is selling every buy, right? So high volume at the lows, instead, you can think of it as a transfer of shares, right? From the fearful to the ones that actually have trust in this name, right? The outcomes of that is usually gonna be an accumulation phase, right? But if a name is just like you don't want to be first to a stage 3, you don't want to be first to a stage 1 either, right? You want to be closer to the last of the person in stage 1 so that you can actually participate in price moving into a stage 2. Always keep it in mind. You want to be one of the last people that are getting into this name when it's in a stage 2, stage 1. That way you can buy in right before it enters stage 2. And same thing when we're talking about a stage 3. You don't want to be first. You want to be one of the last that are coming to trade at the end of the base, when the base actually looks like it's been finalized and price is actually going to break down. That way you can enter right as price is entering a stage 4. You don't want to be short when price continuously is continuing to build out that stage 3 base, because you're just going to end up getting chopped up. Right, so high volume at the lows is usually panic selling into what is called strong hands, right? Or institutions that are buying things off of the lows, right? And that also goes back to 2 questions to ask whenever price hits the highs, right? You can think of it the same thing. When price hits the lows of a base, 2 questions to ask when price, what was the exact? I was on Bitcoin. Let me just copy paste it. That was Baidu. Right, just simply switch out the names, because everything that we talk about, right? Not everything, but 95% of the things that we talk about work vice versa. Right? What did price do prior to that low test, and how did price react to that test of the lows, right? When price is coming in to test a low, right? Was price just kind of in a free fall, right? Easier for institutions to sweep a low, or was price consolidating and then going for a breakdown? Harder for institutions to sweep that, right? Because price has rested, price is consolidated. That means price can potentially break down hard. If price did not consolidate, then it's easy for a sweep to happen. Right? And the second question is, how did price react? Right? You always want to see these lower wicks, right? Bullish engulfing bars, just like this one here on very high volume, Right, this is a good example of someone that tried to be first to Baidu. Right, this was just coming off of. I mean, this is a very kind of funky chart, but this was a massive downtrend. Right, someone tried to buy this name and be first here. They waited. Actually, I mean, they kind of did turn a profit here, but for price to really get some proper momentum, it took 1,400 days, 200 weeks for price to actually get some serious momentum, right? Because this wasn't any serious momentum. This was prices continuously chopping. But here you can clearly tell that price is breaking out of the base, and this will probably continue to move out higher. All right. So anyone that was first had to wait and had their money locked up in this name for quite a long time. And when it comes to options, they obviously got burnt time and time again. Right? Same thing with INTC. The person that tried to enter to be first to this base, right, had to wait for months, right, 371 days before price actually got some continuation, right? Instead, the ones that waited for price to consolidate near the highs, right, and near a proper breakout, those are the ones that eventually got paid, right? And this is actually a good example of one of the things that I was talking about just now, right? What does price do when it approaches the highs of the base? Look at this here. What did price do when we got this high volume? Ask yourself the two questions. Price ripped straight up into that, and you'll see that didn't get any fall through because it had ripped an X amount of days in a row, right? Even though price did have an initial very strong reaction, the next day it gapped down. Now compare this to something like this, right? What did price do here? We popped up, right, got some high volume, and then began to consolidate, and then broke out on that catalyst that we had, right? Those are completely different charts. This was also a good one here, right? But this one didn't really have that high of volume, and it just ended up failing, which is part of trading, right? As we know, things are gonna fail, right? And then fast forward to today, and this has ripped all the way up into 54, which is just insane. These drawings that I have here, I made them quite a long time ago. I mean, I've been all over this chart for quite some time. It hurts to know that I sold my comments on this. I had buys off of right under 20, which is so painful to look back at, man. I was buying it down here on this kind of contraction pattern here. That would have been, man, that would have been a 170% win on commons. Yeah, and the week before it broke out, you guys want to see something that's so painful? I had options on this a week before it broke out, and yeah, Mooch, it was on my Substack. If you go back to this week, you'll see me talking about this on my Substack and calling for this long. I went long on this day here, Wednesday, September 10th. I remember this very clearly. Didn't get any follow through and stopped out on Friday. I was just 3 days early to a 27% overnight move, which would have put my options, I don't even know up how much, probably like a 10x or something like that. Because I wasn't in any dated cons. They were more like closer expiry. But yeah, from there it's just a straight grind up with dips getting bought up. But yeah, so when high volume comes in at the lows, right, you want to see what price does. You don't want to be that guy that just buys in whenever high volume comes in. No, you want to watch and see that price is actually reacting to how you want it to react, right? You see the sweeps, Right, back here there was no any true sign of buyers, right, early in the base, just by looking at the reaction of price. Nothing that is substantial, right? Nothing that is anything crazy, right? High volume, yes, but no true reaction from price. Now compare this to down here, right? Now obviously there was a catalyst here, but still, right, you start to see price really begin to move out until it finally did break out. Now, next up is low volume at the lows, right? What does that usually mean? To me, I don't want to, I'll never go short on an extremely weak name, right? Let me just put that out first. A lot of people were asking me whether I wanted to short some of these solar names back in kind of October, when I was looking to go short on Nvidia somewhere up here. I saw about it on Twitter, and a lot of guys in my comments were like, why are you shorting the market leader? Why don't you short something that is weak, just like these solar names, just like EN, PH, Enphase Energy, right? And the reason for that is because names that are very cheap, right, and names that are hated by everyone are going to be the names that are entering into accumulations, right? As we mentioned, accumulations begin when names are most hated, and distributions begin when names are most loved. I want you guys to print that out and stick it somewhere on your desk. A name like EMPH, right? I could have definitely gone follow through on some of these pops, right? I could have easily shorted some sort of breakdown and got some follow through. But I just increased the probability of me getting swept by a ton. Right? So I much rather be the guy that's shorting something that is coming off of the highs than be a guy that is shorting something at the lows, right? Maybe I'm more of a, I don't know the word, hold on.
Contrarian.
You guys heard that right. Maybe I'm more of a contrarian trader, but yeah, that's the way that I like to trade, and that's the way that I found my personal success. And I think it just, one of the main things that it does is that it gives you a ton more room to the actual moves, right? Think about it this way: a name that has already broken down or sold 70% of the highs, sure, it can sell another 10%, but compare that to a name that has just come off of a 200% run up, right, and now can pull back 50% of the highs. I much rather be shorting name number two. Obviously, if price shows me that, right, that goes without say. Right, until you short a coin lately, I didn't pay much attention to a chart far down. Yeah, coin was this was a very clean short. It wasn't that at the it wasn't at the lows though. Right, on the daily, kind of, yes. But I mean, when thinking about it from a weekly perspective, I wouldn't necessarily say so. Right, I'm more so talking about names just like solar names, right? Or what else is there? Solar names are the only ones that are popping into my head. But yeah, so back to what I was talking about. Okay, so volume at the lows, right? Volume at the lows is something that I don't really pay attention to. When I see volume at the lows, I just kind of push a name to the side until I see volume pop back in, because I don't want to go short a name at the lows. Right? I much rather long a potential breakout at the highs with low volume at the highs than, sorry, long. Did I just say long? But that was a tongue twister. I much rather long a name with low volume at the highs than I am for a breakout than I am to short a name with low volume at the lows for a breakdown. Right? Because names, generally speaking, the stock market does go up. I don't want to make it more simple than that, but don't be a guy that's looking to go short all the time. So when you have two very similar charts, one to the downside, one to the upside, choose one to the upside. Or keep trading easy, depending on the market environment, of course. But I'm talking if we just kind of in a hypothetical situation. right? So to simply tie this into the trading system, avoid longs on breakouts when volume is extremely high and price is not reacting in a breakout manner. You're not seeing a strong close, right? You're seeing instead a massive sweep. Definitely avoid that long. I'm not saying go ahead and short it, right? But definitely avoid that long. You want to look for instead longs after, for example, on names that are coming into bases, right? And you see high volume after selling climaxes, and then names begin to base, right? Those names are going to be much better longs than the ones that I just mentioned, right? So always keep that in mind. You guys have any questions so far? There are a lot of fake outs before it comes out of a base. How to avoid that? How to avoid being faked out? Well, ask yourself these two questions. All right. If price has ripped into the breakout, then there's a higher chance for institutions to sweep that high. And if price reacted with some sort of wick, right, or price failed to reclaim or actually break out of that high, then chances are there's a higher chance that it has a fake out, right? However, if price slowly staircases its way up into that high and into that resistance, and then you see the volume pop in and you see price actually follow through, then you are putting yourself on the side of more likely not getting faked out and price actually continuing up higher. When is it appropriate to take the buy the dip, sell the rip? Any pointers on what to look out for aside from listening to your morning saw snippets? Yeah, look for price to be in a range. That's number one. Right. Perfect example is today's market. Let me just clear this. Price isn't clearing a base. The ones that poured in short yesterday got squeezed out today. And I think more likely than not, the ones that are looking to go long today are gonna get faded. Right. Go back to the market from December 18th to February 21st. I've studied this market so many times because it represents exactly what a rangy market looks like and how you can actually make a killing in a market that's in a range, right? I think I doubled my portfolio in this range, while most people were just kind of getting chopped up. And the reason for that is because they were looking for home runs on every single trade. Every time they were buying some sort of long, they were hoping for the market to break out of this base, and then it wouldn't. And every single time they'd pour in short at the lows, they were hoping that this market breaks down out of this base, and the market just wouldn't. Instead, know that the market is more likely to continue out in this range. Why? Because we just came out of a pretty big rip, right, from the April low. Not April, August 5th. Right, so 93 trading days of just straight up. It's going to take some time to build out this base. Don't buy longs up here. Don't buy shorts down here. Instead, look for a pop to short, a weak pop, just like here. And right as you see head and shoulders drawings on everyone's charts, because price is going to do this and break down here, this is going to get bought. Right, this swept this low and it got bought, and then this reversed. And everyone that went short here got squeezed out, and then price came back down, and everyone thought, okay, this is gonna be the time where we actually break down from this low. Nope, you're all gonna get swept, and we're gonna move back up to the base highs. Price just kind of grinds its way higher, right? I'm not saying you're not gonna short these days. I went short on this day and I lost, but then I went back short on this day via Nvidia and won on the DeepSeek. And then what did I do? I took my win here. I waited for price to pop again. Where did it pop to? Gap fill, rejection. SMH gaps down this weekend, 4%. Another big win. And then I went short somewhere within this kind of range and lost. But then I didn't go long up here, right? I wasn't going to be the guy that's looking to buy a 3-day pullback to the 8-day, right? This is not how markets actually work. Because we set up a 3-day consolidation pattern at the highs, it means it's going to break out. No. I went short. And then we broke down. When did I go long? You may ask. I went long on the 2nd of January on this failed breakdown. Guess the name that I went long. TSM. 2nd of January. I was even alerting this. I don't know who was in TOC back when I was alerting, but this is the name that I was in. What did TSM do while QQQ had a failed breakdown? Because everyone thinks that this is in a head and shoulders and it's gonna just die down. TSM, what was it doing? It pulled back into the daily moving averages, undercut them a bit, messed around, filled the gap, right? If you want to pull fibs as well, you can. Bullish engulfing, breakout. 3-day breakout. And this was my new record trade back then. That was the only meaningful long that I remember within this base that I had. However, there was certainly some more opportunities like this. I think there was some sort of catalyst. I think it was GDP numbers, maybe. But yeah, one of my best markets that I traded was this range, right? I was looking to buy the dip, sell the rip. We rip, I'm looking to short that. We dip, I'm looking to buy that. Not blindly, of course. I'm waiting for price to react to my levels. See reclaims if I'm looking to buy the dips, right? See volume coming off the low, right? Hammers, large lower wicks, strong closes. I'm looking to buy the dip, right? Price rips, kind of gaps up 2-3 days in a row. Pushes up into some sort of range high or some sort of resistance, or fills some sort of bear gap or tests into a bear gap, and I'm looking to sell that rip and look for the markets to move back down. That is one of my favorite sayings that I'm sure it's out there, but I remember coming up with it when I was kind of just back testing. Buy the dip, sell the rip whenever in a range. Sell the rip, buy the dip. Rinse and repeat. Don't be in stocks for too long. Market is in a range. Market continues to be in a range for quite some time. Keep doing that. Yeah, gap and crap. That's another one. One of my favorites. I love shorting gap ups. You get a big gap up. You get a failure off open. You look for the lower high into that. You risk the opening print. Price below the opening print. Your stop loss is going to be about 5%. You try to get your ads as close to the opening print as possible. You go short there and you capitalize on TP1 being the overnight gap fill, and then look for lower from there. We'll be breaking down all of that in the next 2 weeks. Don't worry, guys. But yeah, you guys have any more questions for today? Let me see if there's anything else I wanted to talk about. Also, guys, please, whenever you are attending these classes, make sure that you're trying to tie everything together. Right, as I mentioned, my system is the boot camp is me teaching you my system from A to Z, and every part of my system complements the other. Right, so always think, how can I tie today's session into yesterday's or the day before or last week's? What is a mental framework that I learned in the past that I could apply to today's session? How do you differentiate between opening, closing day volume with the massive volume at lows or highs? Do you mean like when volume pours in at the end of the day, when it's usually just higher volume? So I usually pay attention to the daily close. Right, so if volume poured in at the end of the day but price failed to get a weak close, then I wouldn't be worried about that. But I am also watching price closely intraday to see how price is reacting. So if you get a massive sell-off, for example, of the open, right? Actually, a great example is this. So QQQ on February 20th. Price had pretty much average volume, slightly higher than the past couple of days. Right, and most people thought this is a large upper wick, which they would be right when looking at it, right? But I was paying attention to the lower time frame action alongside the daily time frame. On the daily time frame, we had already ripped multiple days in a row, right? So I was paying attention to that. A hammer at the highs is very different to a hammer at the lows. Keep that in mind, right? We want to be longing hammers off the lows, not hammers at the highs. Right? Just because a hammer prints doesn't mean this is an automatic buy. No, if a hammer prints at the highs after a trend up, that's not good. I don't want to buy that, right? Maybe buyers are still trying to hold the price up, but I don't want to buy that still, right? So what I did here was I'm watching the lower time frames, right? If you go down to the hourly, or even the 10-minute, what happened here is that we actually got most of the volume on the initial leg down, right? And then throughout this entire day, volume stayed relatively muted and price just kind of consolidated, right? And we look at it on the hourly, this is not something that I want to buy. Maybe I want to buy it down here, but I'm definitely not buying it up here. And then the next day we just broke down. How can you tell when we are entering a range? First things first, I want to look out for where we are in the market cycle, right? Are we coming off of a big trend from the lows, right? Did we just trend up for multiple weeks? Or are we just now breaking out? Right, that's number one. And then number two is I want to watch for price action, how it unfolds. Usually when you start to see some sort of liquidation bars off the highs, just like here, this marked the start of the range. If you look at today's market, October 10th marked the start of this range. Right, so you want to look for these types of bars, right? You want to pay attention to how the action is unfolding. And then you also want to pay attention to, can names get any follow through? Can we actually break down? Or are we instead having a lot of wicks, right? This market had a lot of wicks, right? You can see them here, here at the highs, right? It's not clean kind of action just like here. Does that answer your question? And WH's, did I answer your question? To this day, I get faked out by price making higher lows, thinking it's bullish, but then we break the diagonal trend line and we sell off. Any tips on clues to differentiate between the two? So do you mean how can you differentiate between a breakdown and so for example here, how can you differentiate between this being a breakdown or a higher low? As in, this is a higher low. or a breakdown of this kind of trend. So that's not really a trend, but is that your question? Here, whether this was a higher low. Okay, yeah, good question. I see what you're saying. If you want the honest answer, you don't know. You don't know whether this is a higher low, or this is a break of the trend line. What you do know is don't go short down here, and don't go don't go short here. Sorry, I'm getting a brain freeze, brain fart. Yeah, so you don't actually know. Instead, what you do know is don't go short too late and don't be long too early. Like on QQQ, right? I think it's just a bit cleaner to break down. I would much rather long. Actually, that's not entirely true, but this was a good short, right? This was not a good short because price is already broken down 2%, right? So the truth is you don't know whether something is gonna hold or not. The only thing that you can do is just make sure that your execution, you're not going short on what seems to be a potential higher low. Instead, you're short before that as price enters that breakdown of the trend line. That actually goes back to one of the most important aspects of my trading system, and that is I want to be positioned early. I want to be positioned before the breakout or before the breakdown of the trend. That way, if price pulls in and decides to make a higher low, then so be it. I'm going to take a break-even loss when it moves back up to my entry if I'm short. However, the person that went short kind of late after the trend has broke down here, they're the ones that are going to get squeezed out. Does that answer your question? Like, can you kind of make sense of what I'm saying? I don't know if it makes sense how I'm explaining it. Just to be completely honest, I can explain it in a different way if that doesn't make sense. Okay, perfect. And of course, with trading, right, it's a probabilities game. You want to make sure that the chart looks more of something that can actually break down instead of something that actually has a higher low, right? If you want to talk about even intraday basis, right? A good example of this is Oxy, right? This is actually a good example. You want to add into everything else to the chart, right? You don't want to just simply look at trend line break. This Oxy chart, for example, looks very accumulative to me, starting from the failed breakdown here. So when price pulled back into here, I didn't think that this is going to break this trend and move lower, especially because it just kind of sold off 4 days in a row. It's a lot more likely to higher low and move up. And that's what it did. Although I did attempt it yesterday, but couldn't get that strong close. I was just a day early on this, which is unfortunate, but it happens. Am I making sense? Does that answer your question? So add into it the context of the chart, right? Don't just look at it from trend line, breakdown or not, right? And then position yourself before that. I'm guessing this relates more to VP. How can you predict breaks above or below respective moving averages? So the way that I like to use the moving averages is whenever price is in a range, I like to avoid really staring at the moving averages, right? That's number one. And I only look at the moving averages on the daily time frame, right? Let me just put that out there. I think that moving averages on the lower time frames are just a bunch of noise. If you enjoy using them, then go ahead, keep using them. But me personally, I only look at them when they are on the daily time frame. And I'm looking to use the moving average when price begins to break down or break out, right? I'm not so interested in the daily moving average when price is in a range, right? The reason for that is because when price is breaking down or breaking out, what tends to happen is price begins to exhaust one way or the other, right? By moving up 2-3 days in a row or moving down 2-3 days in a row. How do I know if price is not that extended or is extended? I'll just simply whip out the daily moving averages and I'll try to get my entries close to them. right? And then you also want to watch for how price reacts when we test into a moving average. So for example, NVIDIA, right, we did test into the daily moving average today. When the daily moving averages are above us, they are more likely to act as resistance, and when they are below us, they are more likely to act as support. I don't know if this is gonna reclaim it and pop and go up to make new highs. I don't think it will, but I'm watching the reaction. Right? If you ignore the news that came in, right? This was kind of. Let's just talk about the chart here, okay? Let's just unwind it a bit. Here, oh, I can't do that. This tested into the daily moving average and got rejected intraday, and we got a nice pullback, about 2.5%. Right, so when we test into moving averages that are above us, they're more likely to be respected as resistance, and when they are below us, they're more likely to be respected as support. But you want to pair it with what price does at that, right? If we test into them, see a lot of volume, then you can expect them to hold. Yep, no worries. You guys got any more questions? All right, I'll go ahead and end the stream here then.